All right, let's dive into a real financial mystery that just unfolded in Kenya. The government went out to borrow some money, but what happened next? Well, the response was so massive, it's got everyone asking some pretty big questions. So let's get into it.
Okay, get a load of this number 117.4 billion Kenyan shillings. That is a huge amount of money. And that's how much investors, big players like banks and pension funds, were willing to throw at the Kenyan government in a single day. And this is where things get really interesting. This is the heart of the mystery. See, the government only asked for 60 billion. 60! But the market came back offering almost double that. So you gotta ask, what is going on here? Why the absolute frenzy to lend the government money?
So, to crack this case, we gotta look at the evidence. And the first clue is that the government wasn't just offering one kind of loan, or what we call a bond. Nope, they put two very different options on the table.
Okay, take a look at these two. The big flashing difference is something called the coupon rate, basically the interest payment. They're both long-term deals, but that shorter bond, it's offering about 12.9%. The longer one, though, is offering a much juicier 13.9%. Now, for you and me, 1% might not sound like a lot, but when you're talking about billions of shillings, trust me, it is a huge deal. So you've got two choices, two different payouts. The logical move, right, is to go for the one that pays more. And that's exactly what investors did. But this is where our story takes a really weird turn. All right, this right here is our evidence board. It's the official report card from the Central Bank of Kenya. Now, I know it looks like a wall of numbers, but buried in here is the smoking gun, the key to this whole thing. Let's zoom in on what's really important. Okay, check this out. The longer bond, the one with the better interest rate, got flooded with offers, almost 67 billion shillings worth. But look at how much the government actually took, only 16 billion. They basically said no thanks to most of it. But for the other bond, the one with the lower rate, they accepted almost 89% of the offers. So what in the world is going on here?
And this chart just makes it crystal clear. Look at that difference. They took almost everything offered for one bond. And then for the more popular one, they rejected most of it, taking less than a quarter of the bids. So you've got this flood of money coming in for the better deal, and the government just turns it away. That right there is the central clue we need to solve this thing.
Okay, so we know what happened. Now for the million-shilling question, why? Why on earth would the central bank turn down all that cash? Well, the answer really boils down to two big things. First, it's all about that super attractive interest rate we mentioned. And second, there's a bigger picture thing happening in the economy. The market is just drowning in cash right now. So let's break that down. Part one, that coupon rate, that 13.9%, that's a fantastic guaranteed payday. If you're, say, a pension fund and you need to make sure you have money to pay people decades from now, a predictable return like this is basically the holy grail. So yeah, of course they rushed in to get a piece of it. But here's the twist. Because everyone wanted in, the bidding got super competitive. A lot of investors got aggressive. They tried to lowball their offers, which would have forced the government to pay an even higher interest rate. And the central bank just looked at those bids and said, no thanks, that's too expensive for us. They were in the driver's seat, so they could just pick the best, cheapest offers and toss the rest. Okay, on to part two of our answer, this thing called excess liquidity. Sounds complicated, but it's not. All it means is that there's just way too much cash floating around in the system. Think of banks and investment funds with huge piles of money just sitting there, and they're getting desperate to find somewhere safe to park it and earn some kind of return.
And remember that crazy 117 billion shilling number from the beginning? Well, that is a textbook sign of excess liquidity. All that cash needed a home, and a super safe government bond, it looked like the perfect place. It was this massive flood of money that gave the government all the power to be incredibly selective.
So, mystery solved, we know why the auction played out the way it did. But now we have to ask the bigger question, so what? What does this all actually mean for the government, for investors, and for the Kenyan economy as a whole? Well, for the Kenyan government, this was a massive win. Simple as that. Because everyone was fighting to lend them money, they got to sit back, pick the absolute best offers, and end up borrowing what they needed at a great rate. It's like putting something up for auction and watching a bidding war break out. You're going to get a great price. But for the investors, especially the ones whose bids got tossed out, it's a totally different story. For them, it's a huge wake-up call that this is a tough, competitive market right now. You've got way too much money chasing just a handful of good, safe investments. The takeaway for them is, if you get too greedy, you're going to end up with nothing. And if we zoom out even further, this whole episode might be a bit of a warning signal for the wider economy. I mean, think about it. If banks are this eager to just park their cash with the government, what does that say about everything else? It could mean they aren't finding enough good businesses or people to lend to, and that might suggest that the private sector isn't borrowing and investing as much as it should be. So, in the end, the government got the cash it needed this time around. But it leaves us with this big, lingering question. All that money that got rejected, it didn't just disappear. It's still out there, searching for a home. So this wasn't just a one-off event. It's a sign of a bigger trend, and it makes you wonder, what's going to happen when the next auction comes around?